Welcome back to Learn SKN, and today we have another economics video for you. Today we're going to pick up where we left off last time in economics, CSEC economics. We were looking at the central bank and the roles of the central bank. And so today we're going to go beyond the central bank and we're going to look at the other financial institutions and arrangements that exist within the financial system. So we're looking at things such as the commercial bank, the stock exchange, credit union, development bank, insurance company, mutual fund, building societies, investment trust companies, and other informal ways of handling finances, monies within the economy. And so we're going to use the textbook, mainly the textbook for this one, and we are going to outline what some of these are and some of the services that they offer. So let's just jump right into it. And so we're looking at the commercial banks. And so most of us will be familiar with this type of bank because this is the most prevalent one as it relates to this is one that comes to mind first when persons think of the financial system. When you think of borrowing and savings, this entity comes into mind first, the commercial bank. This is normally the intermediary between the borrowers and the lenders. And so a commercial bank provides individuals and firms the banking services. Commercial banks are profit-making enterprises. Some commercial banks in the Caribbean region include RBTT, Republic Bank, Scotia Bank, First Caribbean Bank. You have your national banks of various, Antigua, St. Kitts, wherever national banks, Bank of Nevis, those kind of banks. All those are commercial banks. So some of your domestic banks would be considered commercial banks. As long as it's not the central bank, then it would be a commercial bank. Commercial banks accept deposits from individuals and firms. The depositors are paid interest by the bank. The rate of interest is the price charged for borrowing money. And so the commercial bank is the one that accepts deposits in various forms from individuals and companies. So you have your saving deposit, the checking deposit, you have different things. And so those are some of the services offered by the commercial bank. The commercial bank makes loans to individuals, firms, and the government. And so because the commercial bank is the one that has the savings from other players in the economy, they are the ones who also allow for loans to be made from those savings to all players of the economy, private sector, government, households. So firms, households, and the government can all obtain loans from the commercial bank. Individuals might need a loan for purchasing a house for educational purposes or to start a small business. Firms use loans to invest and they might create more jobs. The government might need a loan to meet expenses or to bridge its current expenditure if revenues do not come in on time. So sometimes something might happen, and instead of getting the monthly tax coming in, the government need the money right away, and so they can go for a loan. Or if the tax coming in, something happens and the revenue dips, there's a shortfall, they can always go to commercial banks for some monies to carry out their mandates. Commercial banks offer safekeeping services. Of course, you can have a safe there to store your jewelry, store your heirlooms, whatever is precious to you. You can use the commercial bank with their vault and things like that to have your night box and your safe deposit box and stuff like that. Customers use the banks for safe deposit boxes to store important documents and valuables such as property deeds and jewelry. Commercial banks offer a wide range of services. Services offered by the banks include letters of credit, bills of collection, customer payment services, check service, credit and debit card service, and 24-hour banking. You have ATM and things like that it can offer to you. And of course, you can think about many other services offered by your local commercial bank. You go to your ATM and all those other things. What they call that, the standing orders when you want to pay your bills and things like that. So those are some of the services offered by the commercial bank. Now, commercial banks offer foreign currency banking services. Banks issue travelers checks and buy and sell foreign currency. They issue bank drafts in foreign currencies. Commercial banks in the region now accept deposits in foreign currencies such as the US dollar, Canadian dollar, and the pound sterling. And of course, I don't have to tell you that they also offer those, your credit card, debit cards, and all those things. So all of those services offered by the commercial bank. And as I said before, with the central bank video, I also did a video for POB outlining the services offered by the commercial bank. So you can check that out and see what we are talking about for a deeper understanding. But they tend to be some of the same content. Commercial banks are financial intermediaries. They bridge the gap between borrowers and lenders by offering a rate of interest on deposit. Banks entice individuals and firms to save. And so we know how the interest rates come about based on what we said with the central bank earlier. Saving form the basis of growth and development in the economy. Savers are paid interest to deposit their funds in the banks, and borrowers borrow these funds at a higher interest rate. The bank therefore provides funds for activities such as investment, home ownership, and education. They provide services that aid trade within a country and between countries. So this is just a synopsis of some of the main things that the commercial bank does as it relates to the financial sector. And of course, moving on from the commercial bank now to the share market or the stock market. So a stock market or a share market is a market for trading of company stock or shares. I mean, that goes without saying. Stock market, shares, company, they are traded there. And we know from other videos that the public limited companies are normally those companies that are allowed to, share, to trade their shares on the stock market. But then, some municipal authorities can sell their bonds and treasury bills and all those things within a similar market. So we could always call it the securities market, right? So all those securities, some from government, some from companies, that they are allowed to, trade on these markets. A company's asset can be divided into equal parts called shares. A collection of shares is called stock, right? So that's basically the outline for the share or stock market. And so that is where you go and buy and trade your stocks or your shares. The buyers might be other companies, banks, and non-bank financial institutions or private individuals. The items traded are the shares of different companies. And so you know that the stock market allows for almost anybody in the public domain to buy and sell shares or stock for a publicly traded company. Of course, right here in the Caribbean, we have our very own Eastern Caribbean Securities Exchange. That's one of our stock exchange, and you have a lot of different companies listed on this stock market, the stock exchange. You have from Grenada, from Dominica. You have Grenada Cooperative Bank Limited, Grenada Electricity. You have from St. Kitts, you have TDC, National Hosfords. You have the Bank of Nevis. Dominica have the electric company. You have St. Lucia have the electric company and some other holding companies. St. Vincent has their bank. And so these are all, on the exchange within the Eastern Caribbean. And so you can, we are young, we are new into this thing, the Caribbean. So you can always go on when you get older and try to invest in some of our local or regional companies out there. All right, so back to this. Stock exchange. The stock exchange is a corporation that brings buyers and sellers of company stock together. The stock exchange is also called a bourse. It's also called a bourse. It provides facilities for stockbrokers and traders to trade company stocks. A stockbroker is a licensed individual who acts as an agent for clients buying and selling shares in the market on the client's behalf. The stockbroker really makes the market as he or she brings buyers and sellers together. To be able to trade shares on a certain stock exchange, the company has to be listed there. The company must be a public company. Some examples of stock exchange in the region are the Trinidad and Tobago Stock Exchange, the Jamaica Stock Exchange, the Guyana Stock Exchange, and the Eastern Caribbean Securities Exchange. So as I showed you just now, That is the one for the Eastern Caribbean, but Trinidad has their own, Guyana and Jamaica has their own. The stock exchange facilitates the trading of shares, as the exchange is responsible for the collection and delivery of shares. It guarantees payment to the seller. This eliminates a risk to an individual buyer or seller that the other party would default on the transaction. The stock exchange contributes to the increased prosperity of the economy, as businesses obtain funds and the companies and the households have the opportunity to invest and even make profit. So in America, a lot of people play the stock market and they make a lot of money from that. In the Caribbean, we're a little bit more, we're not as mature as the American system, but still we're getting there. So we should all try and invest in our regional stock exchanges. You have some apps that have been developed for stock trading and stuff like that, such as Robinhood and Mint and those kind of apps that can be used to buy and sell stocks on the stock exchange. But for now, in the Caribbean, we have to use our brokerage firms to get that done. Of course, you have to pay the middleman their monies. But the stock exchange is a very good way for individuals and companies to raise capital and make some money. All right, so we have the credit union now. So we looked at the commercial bank, we looked at the stock exchange. Now we're looking at the credit union. So I know some people tend to mix up credit unions with banks, but they are not the same, far from. I mean, sometimes a credit union, credit unions require a bank themselves. So now they would bank with a commercial bank, the credit union. They would have their own account in there and they bank with that bank. So, but credit unions is a type of cooperative, right? But this time it's not, it's a financial cooperative. So people come together as members to save money, to lend each other money and things like that. So, there are other cooperatives where, it could be a production cooperative where you make things as a group. You could be a marketing cooperative where you market your products as a group, and a whole number of other things, right? So the cooperatives. A credit union is a cooperative financial institution that is owned and controlled by its members. So that's the next key difference there. Owned and controlled by its members. Credit unions differ from traditional financial institutions in that the members who have accounts in a credit union are the credit union's owners. Some of the credit union in Trinidad and Tobago are, you have a whole long list of them, the Eastern Credit Union Cooperative Society, but you get the gist. Only a member of a credit union can deposit money with the credit union or borrow money from the credit union. So you have to be a member to take part in any activities as it relates to borrowing and saving with a credit union. With a bank, you don't have to be a member. You just go, open your account, and you can save and you can borrow and you can do that kind of stuff within a commercial bank. But credit union, it only allows for its members. So everybody have to buy their shares before they can even start to conduct any business with the credit union. The credit union is committed to helping its members improve their financial situation. Credit unions typically pay higher dividends on shares or interest on deposits and charge lower interest rates on loans than banks. So those lines alone should tell you where you should take your money, right? One of the most advantageous things about the credit union is these things listed. You get lower interest rates on loan, higher dividends on shares, things like that. And they actually give you a higher interest rate on your saving accounts. So you should always look at credit unions as one of the better options when you're contemplating saving and things like that. You want to go for student loan, you want to go for mortgage or stuff, you should consider a credit union because more times than not, they have better rates than commercial banks. Credit unions are not as profitable as banks as they focus on serving members. And that's the key thing right there. The focus is the members, and so they're not all about gouging out your eyes to make some profit for the shareholders. That's one advantage of the credit union right there as opposed to commercial banks. Then we have the development bank, and as its name suggests, a development bank is an institution set up to facilitate growth and production in a particular sector in the economy. For example, agriculture. You might have a bank dedicated to developing the agricultural sector within an economy. So persons in that sector can go and get loans and grants and things like that and assistance from that development bank, because as they say, they're there to develop a particular sector. It could be a small business, the small business sector, and so you have a bank dedicated to that. Or the bank, the major development bank has facilities within it to aid in certain ventures within the economy. Development banks do not accept deposits from the general public. Funds are obtained from international and regional institutions and grants from the government. The development bank might invest its idle funds in securities in order to increase its earnings. An example of a development bank is the Agricultural Development Bank of Trinidad and Tobago. So normally, right, if an institution like, let's say, FAO or IECA or some of the UN bodies want to conduct, want to help develop an area in a country, they will go through that development bank. Again, if the Caribbean Development Bank, there's a Caribbean Development Bank, and they normally work alongside other institutions like I said before, IECA, FAO, EU, all those things to help to develop the Caribbean on a whole. So if you have something for sustainable growth or sustainable this or green data or climate change programs, projects, they will go through whatever development bank to get the project done. Or governments can also put money into those banks to be accessed by certain individuals or firms from a certain sector. For example, if government want to develop agriculture, as I said before, they can put money in that bank that can only be accessed by farmers or whoever meet the criteria. And of course, you have insurance companies. Insurance companies, I did a video on insurance for POB, so you can always check that if you want a more in-depth understanding of the insurance company. Insurance is an arrangement whereby a company guarantees to give compensation for loss of life or property, for damage to property, for injury, or for illness in return for payment of a regular sum of money that you call a premium, a monthly premium. Insurance companies provide insurance. Some examples of companies in the region are Sagico, Clico, Nagico. You have a whole lot of different insurance companies. You can name your local insurance company. They operate on the principle that not everyone will suffer the same loss to the same extent at the same time. So everybody pooling their risk together because they know that for the most part, everybody's not going to have a house fire at the same time. Everybody's not going to have a car accident at the same time. So for those who are not, suffering a loss, the monies that they pay monthly can be used to help the person who's actually in dire straits or in need. And so that's the whole idea of insurance. You pool in the risk so that when one person suffers a loss, they pull from the pool to help that person get back to where they were. Not for profit, but to get back to where they were. Insurance company receive funds from the payments of premiums by those who buy insurance. When the buyer suffer a loss, the insurance company must compensate the buyer of the insurance for or his beneficiary. So insurance is just there to help you to be, as they say, yes, better safe than sorry. It's just like a tool put in place to mitigate risks, to reduce risk. So you know that if something happens, somebody got your back, they're going to compensate you for whatever loss you would have suffered. The service offered by insurance companies are a security to firms and individuals. Private companies is protected against risk of loss. Businesses are protected against loss or damage of property by fire and the stock of goods in transit from, if you're importing something, if the ship sinks or if they get lost, you can be compensated for that. Insurance companies offered security for traders. Insurance companies use their funds to purchase government and private sector securities. Therefore, insurance companies also provide a source of fund to government businesses. So insurance companies are there to help you to mitigate risk, to help you to get back on your feet if something happens, if you suffer a loss. So what is a mutual fund then? A mutual fund is a collective investment company. An investor buys a share in the mutual fund and is paid dividend based on the number of shares he holds. The dividend might be at a fixed rate or it might vary depending on the performance of the fund. The fund pulls money from many investors and invests their monies in a range of securities. The advantage of a mutual fund is that the investor has the services of an expert fund manager to make investment decisions. The investors' collective funds are used to invest in securities to which individual investors might not normally have access to. So what's a mutual fund in a nutshell? So a mutual fund is, as they say, is a collective investment company. So persons would ask you to buy shares in this company, and then they would take that money and they would invest it in a variety of different companies, a lot of different companies, build a whole portfolio. So they might take your money and invest it in, maybe they invest it in Grace Kennedy, they invest it in Clico, they invest it in maybe Trinidad Cement, whatever. But they invest your money in multiple companies, not just one, multiple companies. They normally try their best to balance these companies so that they can always come out on top. So if a company is opposite to a next company, then they would invest so that when that company goes up, your money goes up. But the one goes down, the other one goes up, and so you're still balanced off. Right? So that's one of the reasons, that one of the advantages of these mutual fund companies. You have persons who actually sit down, and the brokers, and they do their investment for you. Right? Sometimes, they get hit hard, and then, all your money is lost. Some people actually invested their monies, their life savings in mutual funds, and then when they had the financial crisis in 2008, persons lost a lot of their monies, their savings. Right? So you have to be careful as to, it's risky, it's the stock market, and you know that if the stock market fails, if a company fails, you're going to lose your money. And like I said, that's why they might try to invest in opposite companies, or companies that, that helps each other. Right? So they might invest in both airline EV company and a fossil fuel company. So if electric vehicles are becoming more popular, then that stock goes up. But that would mean that the fossil companies stock go down. But because they invest in both, they win. It's a win-win for them. So instead of putting all the stocks in one company, put it in different companies, variety of companies, so that it can balance each other. So that's basically the gist of a mutual fund. So instead of you having to go and invest in 10 different companies, you just invest in the mutual fund. They would invest in a variety of companies, and when the dividends go up, you get paid. So it's a little simpler. All right, building society. A building society is a financial institution owned by its members, similar to a credit union, that offers banking and other financial services, especially mortgage lending. The term building society first arose in the 19th century in the UK. Groups of people pooled savings so that members could buy or build their own homes. Today, building societies offer services similar to those of commercial banks. Such services include a range of savings accounts, money transfers, and foreign currency transactions. They still offer loans and mortgages for homes and land ownership. Also, in some building societies, loans are available to non-members. That's how it differs from the credit union now. Two examples of building societies in the region are the Jamaica National Building Society and the New Building Society Limited of Guyana. So these are things that are not as popular as the credit union, the commercial banks, but they're there still. They are part of the financial system, and they can help you with certain financial assistance. Then you have investment trust companies, kind of similar to the mutual fund in a sense. A trust company accepts deposits from the public. These deposits fund commercial mortgage for the corporate sector. Trust companies therefore make funds available to very large firms so that they are able to make capital investment. In Trinidad and Tobago, trust companies also service the lower end of the market, one such being the Housing Development Corporation, HDC. By servicing the HDC, funds are made available for the government to provide low-cost housing. Trust companies have assisted in the development of the capital market in the economy through the management of shares issued of public companies. They also assist through the purchase of government and private securities. As buyers of securities, investment trusts are a source of funds to the private and public sector. So very similar to the mutual fund, but of course their thrust, their motive is somewhat different. As they're saying here, they are normally there to help to fund things like mortgages and home buildings and things like that, and for companies to invest in various endeavors. So they are there to help the corporate world invest in various endeavors, and so they are somewhat different to the mutual fund in that regard. But nonetheless, they are part of the financial system, and they assist both the private and the public sector to achieve certain financial goals. So it's all about, you know, buying and selling of securities the same way. Then we have the informal institutions, right? So informal mean like the underground, the off the books, the not so regulated kind of institutions. And so we have some old school ones here. We have what you call the susu. That's another way of, you know, well, should I say saving money, or, you know, well, in other countries they call it the partner hand, or the susu. This is an informal arrangement between a small group of people who contribute an equal fixed sum each week or month on payday to a common fund called a pot. And then every so often, maybe every week, every month, somebody gets that pot and it goes around until everybody would have gotten from that pot and they start again, right? And of course, you know, some people don't really love the idea of a partner hand or a susu because they say you ain't getting the interest. But sometimes, you know, the money drop in real nice, real good, and you can have that money you would have otherwise spent elsewhere to drop in your lap one time, and you can do business with that kind of money. The total amount paid in by all participants goes to one member of the group each month or each week, as I said before. So that's what you call the partner hand or the susu. And so it still goes on today. You know, a lot of parents, grandparents, they still do it in the Caribbean. I'm sure some of y'all out there know a mother or a sister or brother, an uncle or granny who still engage in this kind of financial service. You know, the informal one, the susu, the partner hand. Moneylenders in the Caribbean society, moneylenders are usurers also used to conduct a fair amount of business. You might question how fair the business was. The usurer usually lend money at a very high, so this is basically a loan shark we're talking about here, right? A very high rate of interest to borrowers. However, the borrower might not have to put up any security collateral at all to obtain the loan. Moneylenders and the activities still survive in the Caribbean society, especially. So basically we're talking about a loan shark in a sense here. Somebody go and, you know, lend monies and you have to pay them back at a very ridiculously high interest rate. And of course, you know, this practice has a very negative connotation now. You know, people, you know, get themselves, you know, broken bones, broken fingers, because, you know, you're poor and somebody lend you money at a high interest rate. I mean, you're not going to be able to pay it back, and so you have problems. And so that's an example of, you know, it's informal because you can't even go to the police really and truly. Because you go to the police, it's trouble for you and your family, because these mafiosa, mobsters, you know, gangsters who lend you money and thing, loan sharks, they're going to want the vengeance and stuff like that. So that's why they say it's somewhat, you know, it's very questionable. All right, but all those are still informal types of financial services, if you want to call it that, or informal credit institutions as they call it here. And that's basically it for this part of the CSEC syllabus. So we will have covered the various other financial entities within the economy outside of the central bank. And so that's it for now. You know what to do. Like the video, subscribe, hit the bell, and, you know, share even more. All right, so thanks for watching this one. I know this one was a little long in the tooth. This topic isn't the most, you know, fun one per se, but still has to be done. So thanks for watching. Thanks for listening.